Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. We're delighted to have a special guest with us, John Rekenthaler from Morningstar, a former colleague. John, you were the director or vice president of Research Services, a wholly owned subsidiary of Morningstar, and I think you were at Morningstar for 37 years, almost without interruption, except for a brief period at Nuveen, as I recall. Is that correct?
An 11-month hiatus, but yes.
Ele- 11
Otherwise,
months.
it was 36 and a half years. So your
Okay.
memory is good. I suppose that you could say I have some experience.
Very
Some
good. Yeah,
some the fruit is mature.
that's right. And as I recall, I think you are still the person who has the most knowledge of the asset management industry that I've ever encountered. You've seen the whole industry growing up with the birth of the 401k, mutual funds, now ETFs. You remember all the bad actors, the leveraged bond funds, and all kinds of crazy things.
Yeah, I've seen them all. The industry's a little tamer these days, John, for the most part. Although there's some funny things that go on with some of the newer ETFs. That's
Yeah,
where, back in the day, it was the experiments were done with mutual funds, and now the
that's right.
mutual funds are fading, and ETF is the experimental territory. And
Yeah,
the vast majority of assets in exchange traded funds are in very cheap, very safe, very tame, and so far very profitable index funds mostly.
that's right.
Uh, but there are some strange critters out there on the corners of the industry. So still
There are,
something for people to write about and cover. It's not
for
all
sure.
become dull as the industry has matured.
For sure. And you are, although you're officially retired, you're still staying busy. You're still writing. I think you were traveling recently, and so you're taking your colleague, my former colleague Christine Benz's advice seriously to stay active in retirement, but on your terms. Does that describe it well?
Yes, exactly. I retired in November of last year, and basically when I retired, I thought I would continue to do the same sorts of things I've been doing, which is write about investments, broaden it out a little bit, and also write about some current affairs that are
Yeah,
topics that are investment related, but a little broader than what one could do in Morningstar's, solely on Morningstar's site. But I am
yeah,
writing also for Morningstar. Just I didn't want to be on deadlines anymore. I
right.
got tired of going on trips and I'd be in my hotel room, in Venice or something for 4 hours, telling my wife I have a deadline and a column to file, and my wife telling me I was an idiot, which was probably true. So now I just did a trip recently and didn't bring any work with me.
Didn't bring any work. Good,
Yeah.
excellent. So your attempt to broaden your writing maybe leads us into the first question. You wrote what I thought was a provocative piece for someone at Morningstar. Well, you wrote two pieces. The first one was on March 16th discussing tariffs, and you weren't impressed that they would affect the markets in a serious way at that juncture. And then on April 8th, after President Trump, of course, made the big tariff announcement, and we had Liberation
Liberation
Days.
Day, yes.
Liberation Day, as he calls it. You wrote a very different kind of piece, and I'll quote from it. You made reference to your March 16th piece, and you said, "I will not write the same today. President Trump's Liberation Day tariffs are the most radical economic proposal of my lifetime. If enacted, they will reverse a 75-year trend of increasing free trade and mutual cooperation among the world's developed nations. The global marketplace would begin a new era." And now you continued writing about what that meant for investing, which means that unless the president sharply reverses course, the current investment rules may no longer apply. For more than 40 years, U.S. equity investors have benefited from buying on dips. The last time that tactic failed with any regularity was during the 1970s and early 1980s, when the previously unknown condition of stagflation confounded the marketplace. Well said. You're right. We haven't had a time when buying the dip wasn't appropriate since then. Unpack all that. Explain what
Yes,
that means,
yes. Let me explain because there's quite a bit going on there.
please.
Um, my thesis has been, and I've really written this many times over the years, that presidencies and politicians really don't matter to the stock market. For one, the global economy is just this massive, it's beyond a super tanker. It's about 9 super tankers, lashed together, and political winds blowing against them. They just don't move them around a much. Um, I'm not a conspiracy theorist or a, you know, anti-capitalist or something, but when they say there's nothing stopping the billionaires in the big capitalist system, they're absolutely right.
Yeah.
I mean, the system works extremely well in growing wealth. When I say the system, I mean developed markets post World War II, the
Yeah.
sorts of things I talked about, mentioned in my article. This era of relatively free trade, the modern era of relatively free trade, cooperation among, not among the Soviet bloc countries, but
Sure.
among the developed world. When President Trump was elected in 2016, I wrote an article that said, "Don't this doesn't really have anything to do with the markets one way or another." And when Biden came into office and so forth, I wrote the same. So that's been my general thesis.
Yeah.
However, as I stated in that item, um, we'll see how the tariffs play out, but at least as announced on Liberation Day, and he's backed off of quite a bit, that's a different game. That's just
Yeah.
it fundamentally changes the conditions that I've talked about, and for the first time, I would say yes, a president really can affect uh, not just the U.S. markets, but the world markets. Not in like a 1 day or 3 day sort of thing, because they always had the power to do that. But
Yeah.
the long-term course of it, of course, we don't know where they're going to go. And I
Yeah.
did stop forward. I stopped short of saying, "Here's my prediction," or that things are going to bleep, or anything like that.
Yeah.
But I just wanted to point out that this time feels different. Now, the first column I wrote was before Liberation Day. As you noted, I didn't write that. I said, well, the President Trump had said during his campaign he already had tariffs that he had put in, and Biden
Sure.
had kept them.
That's right.
Biden had kept them,
Yes.
and Trump was talking about more, but it felt incremental to what we already had done, not revolutionary, but incremental.
Yeah.
And so I felt that when the markets went down in February, that really wasn't related. There was no new news about the tariffs. There was a
Yeah.
little bit of talk he would raise it here more and raise it there, but we knew that already from what he
Mm-hmm.
was saying in 2024. I felt the market was just going down because, as you know, that it had felt pretty speculative. Stock prices
Sure.
were high. There was the so-called Trump rally, and it felt like where we were, in 2021,
Yeah.
entering 2022, which I recall you got that one quite right. You talked about the speculative nature of the markets entering 2022 and how I think it was the small company signal, but how these
Yeah.
signals were showing uh, that we might be due for a downturn. But
Yeah.
that was a dip. It was a
Yeah.
long dip, but it was a dip. It was still part of the 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 75-year ongoing
That's right.
pattern that we've had. So that's what I said when I wrote my first column. But then when Liberation Day came around, I said, well, we might now be in a brave new era.
Yeah.
Um, and maybe we are. He's backed off of the tariffs quite a bit since
He
then. It's a
has.
little hard to know where we're at.
Yep.
However, I should note that even with the back off, the 90-day ceasefire, shall we say, with
Yeah.
China still has a 30% tariff, which
Sure.
is a lot steeper than we've had in the
Yeah.
past.
That's significant. Yeah.
Yeah, it's significant. So let's say that I stand by the words of that
Yeah.
second column, but
Yeah.
he has backed off some,
Right.
and it's not as clear that we are entering this new era. Let's just say there's a possibility of it.
Sure. Let's assume for a moment that he reverses again, and maybe it's not as severe as the first announcement on Liberation Day, but it becomes something more significant than we think it might be now. What does that do for investors? What does that do for investing? Does it mean companies become less profitable? Does it mean PE ratios go down? Markets do less well? What did you mean when it looked like things were going to be more severe?
Probably all those things. It's tough to know when you look at the studies. I mean, all economists basically 99% of economists say free trade is the best.
Yeah.
That it is an almost near unanimity among economists that it's one of the few things that they wholeheartedly
Yeah.
agree upon. Economists on the left, economists on the right, economists in the middle.
Yeah.
If you're a trained economist, you've been taught Ricardo and Adam Smith, and you believe in the benefits of comparative advantage and so forth.
Sure.
Um, and so, but actually researching this empirically to see how this plays out is not easy. You can't, there, as with many things in economics, there aren't really scientific tests. You don't take half a country and say, we'll put on a tariff here, the other half we won't put on a tariff, and we'll
Right.
compare how the two halves go. It's like countries may add a tariff, and the next year or two you can observe how their economy behaves, but you don't. Was it the effect of the tariff? A lot of other things have changed too. And
Yeah.
I did encounter a study that seemed to be the most exhaustive. It looked at 150 countries over like a 50-year period putting in tariffs. And
Mm-hmm.
they did find overall a pattern where as tariffs were added, GDP, gross domestic product, basically productivity, the nation's wealth as measured by GDP, the growth slowed down, and the
Yeah.
higher the tariffs, the more it slowed. So
Yeah.
it was a headwind for the economy.
Mm-hmm.
A headwind for the economy, slower growth usually means, um, doesn't always, but usually means lower returns on stocks.
Yeah.
But not could be pretty good for bonds. However, tariffs could also, and their study didn't look at this, but in theory, tariffs also bring in inflation too by
Yeah.
having higher price for goods, and that wouldn't be bonds. So let's just say the implications are likely to be lower stock returns going forward if we have a heavy tariff environment, and they may also be harmful to bonds, at
Yeah.
least in the short term. I, I think that the sense you would have on tariffs would be in the short term they would introduce inflation because of course their imported goods cost more, and you have
Mm-hmm.
to substitute with domestic goods that are not as cheap as the imported goods, because if they were as cheap, people would be buying them, and they wouldn't be importing goods.
Sure.
Um, but over time, possibly the inflation could lower after that switch is made,
Yeah.
and you're probably in a lower growth environment. It could be a environment that benefits workers, though.
Yeah.
That's protect. That's the idea of protectionism. I mean, the irony of this whole thing, right, is protectionism is until now has been a democratic idea. I mean,
Yeah.
the Wall Street Journal, and there's to their credit, they're sticking with their guns.
Yeah.
They simultaneously, in my lifetime, have always detested Democrats and always detested tariffs,
Right.
and now they're in a position where the op-ed pages where they still detest tariffs, but they're still detesting Democrats, although
That's
it's
right.
the Republican who's on the side of it.
Yeah.
So anyway, that's the thought process. But look, there's economic theory, and then there's how that plays out empirically. And as we know from history of economics, things aren't always necessarily that clean.
Yeah. There was an event in 1985. It wasn't the imposition of tariffs, but the Plaza Accord, as it's called. We gathered, the leaders of Western nations at the Plaza Hotel in New York, and the plan was to devalue the U.S. dollar, which is also seemingly part of what's being called the Mar-a-Lago Accord, or some broad sketch of Trump's economic plan. So, not tariffs, but a dollar devaluation. Does that? How do you assess that? Is that?
That doesn't bother me.
Yeah.
Yeah, I mean, to me, that's business as usual. As you say, they had that in 1985. The
Yeah.
dollar's gone through periods where it's been much lower. It's gone through periods where it's been higher. If you're a U.S. equity investor in the last 40 years, in particular, as you mentioned to start this off, you've done very well across those 40 years with
Yeah.
certain periods, and it's not really related to whether the dollar's strong or weak. And that's how I'm
Yeah.
looking at it, is from an investment viewpoint. Clearly, if you're speaking from an industry viewpoint or a business viewpoint, there are businesses that benefit more and industries that benefit more from a lower dollar, and higher dollar is often good for consumers in the sense that we can buy things more cheaply from overseas.
Sure.
But as an equity and bond investor, just say if I'm an investor, I don't think that's particularly material. That's not the sort of thing that I would write about. And frankly, if someone else were to write about it, I'd say, well, maybe this analysis is useful for the short to intermediate term for somebody, possibly. But as a long-term investor, I'm not concerned with those kinds of things. If I got involved with all, that's in the realm to me of normal politics.
Yeah. Yeah. Okay.
Yeah.
Very good.
For if nothing else, it's cooperative.
Yeah, that's right.
Because I should, as I finish up this a little bit on tariffs, I should say,
Please.
the other concern or the other possible change was, as I mentioned, we had 75 years of cooperation. At the moment, it's not a very cooperative spirit. It's more of a sense of each country out there for its own. America First is part of that. That also potentially changes the dynamics of the global marketplace if each country is thinking so aggressively about its own interests.
Yeah.
I don't know necessarily. I don't know if that's a worse place, but I don't think we get to exactly the same place when when trade and other matters are done independently rather than central bankers, say, working together as they tend to do now, signal each other and at least loosely working in coordination.
Yeah. All right. So it sounds like we don't know where Trump stands now, but you're standing by the argument that if we do get severe tariffs, maybe things will change.
I am,
for
and I'm standing by the argument that I told you for ever and ever throughout my career not to pay any attention to politics when it came to investing. But now you should at least keep an eye on it.
Yeah.
I'm not saying more than that. I'm not saying run to gold or run to the hills or the reverse, run to double your, leverage your portfolio.
Right.
But I am saying I think it's relevant.
Sure.
I think this issue is relevant.
Okay. Very good. Let's dig into an asset class that you've also written about, maybe not as recently, but a year or so ago, maybe a little more. And I've had a long conversation with the great journalist Brett Ahrens about this. TIPS, Treasury Inflation Protected Securities. I think the last time you wrote about them, you were a fan. I think they are priced today roughly where they were when you wrote about them, which is to say the longer term ones are giving you something like inflation plus 2 to 2.5, maybe even a little more today. Talk about TIPS, why you like them, where investors should hold them. Take it away.
Yeah. TIPS, Treasury Inflation Protected Securities, are an odd beast.
Yeah.
In theory, they sound straightforward as opposed to a traditional Treasury note or Treasury bond that says, I'm going to pay you 4%. You buy it and it pays you 4% a year. TIPS will pay you a certain percentage over the inflation rate. Right now, when I look today, the 10-year TIP was 2.17% over the inflation rate. You get closer to 2.5, yes, when you get out to the 30-year TIP. So they're sold. They're comparable to Treasury note or bond. You could buy a 10-year nominal, what's called nominal Treasury, or a 10-year Treasury inflated TIPS, Treasury Inflation Protected Security. Yes. And the two work just the same way. They pay you a coupon and so forth. It's just that the TIPS pay you a rate over inflation. I mean, it's not quite like that because you don't get that in cash every year. You get, but effectively it works. It works the same.
If held to maturity,
if held to maturity, yes, that's the thing. Well, that's also true. People often think that nominal Treasury bonds are risk-free because the government guarantees them, and you're going to get 4%, and the government guarantees them, but they're not risk-free in the sense that you don't know what you're gonna, unless you hold it to maturity, you don't know what you're going to get. Yeah. And as a side note, this was actually an issue when I joined the mutual fund industry in 1988, because the most popular funds at that time were Treasury bond funds, and with the name government guaranteed attached to them, and people thought government guaranteed meant they couldn't lose money in the fund. Yeah. But they could lose money in the fund when interest rates changed. Sure. Well, TIPS are even more so. TIPS have, TIP prices went down in 2022 even as inflation rose, which puzzled a lot of people.
Yes.
You buy these as an inflation hedge, and wait a moment, the price on my security goes down. And that gets to kind of a complicated mechanism with how tips are priced, because, as I said, they're priced by this real, this payment over the rate of inflation.
Yeah.
And at that time, they were paying a much lower rate. So they became more attractive,
Yeah.
and that hurt the price of the tips. So
Hmm.
the bottom line is, if you're not holding these to maturity, I don't really advise them except for very experienced investors, because they're difficult to understand. But
Yes.
if you're holding them to maturity, say by a 10-year tip, I think there's a lot to be said for being guaranteed 2.17% a year over inflation.
Yeah.
Um, Another way of looking at how tips function is to compare them with a conventional treasury.
Hmm.
And there's something called a break-even rate. The
Yeah.
break-even rate represents the inflation rate at which, if the inflation is above that rate, you're better off owning the tip. If
Hmm.
inflation is below that rate, you're better off holding the conventional
The
bond,
nominal. Yeah.
nominal bond. It's at 2.37%.
Hmm.
How many people think inflation is going to be, or at least are willing to bet heavily that the average inflation rate is going to be less than 2.37% for the next 10 years? And if it
Right.
is, maybe it's 2.1? You're
Yeah.
barely better off
You're
owning the
barely. Yeah.
nominal. And what if, for example, tariffs come in earnest, price of Chinese goods double because of the tariffs,
Hmm.
inflation is 4%, 5%,
Hmm.
then you're much better off with tips. So I think it's pretty clear that for a bond, say a typical investor, over a 10-year period, that the risk reward is in favor of tips rather than a nominal bond.
Yeah.
Now the math does change a bit, because tips are available with treasuries, but they're not. You don't get inflation protected corporate bonds, for example, and
Right.
you can buy corporate bonds uh, where you give up a little credit quality, but you get higher yield on them for nominal bonds.
That's right.
So this is just one part of the bond market. But if you're looking for the highest credit quality segment of the bond market,
Right.
treasuries, I would recommend tips over nominal bonds. Yes, and for historic comparison, this I mentioned that, and you mentioned that the real yield on tips, or the amount that paid over inflation, is between 2 and 2.5%.
Yeah.
That they crossed that line at least on the 10-year tip last October.
Hmm.
That's when before then wasn't until early 2009 we'd had that. We'd gone 15
That's
and a
right.
half years
Yeah.
before we'd hit that mark. Often, almost always, the number was below 1%. Often it was actually negative, which is
Yeah.
brutal. I never understood why anybody would. When you want a tip with a negative yield, what it means is you're paying the government every year. Uh, you're saying, give me back less than the rate of inflation, government.
Yeah.
I'll give you my money, and you're going to pay me something that's less than the rate of
Yeah.
inflation. That was not an attractive deal.
From early 2000 to early 2002, I think a lot of tips, if you bought them, you were locking in a negative real return, inflation minus something.
Yeah, yeah, no,
So,
2020 was 2020, right around the COVID time, was a bottom too, and it was,
yeah,
and there was it's a the reason this happens is if the rates on nominal bonds the payout becomes very low, and that was the case in 2020. The 30-year bond was down almost about 1%. Can
yeah,
you imagine?
yeah,
Nominal bond. I'm going to take 1% a year over the next 30. I'm not even going to double my money over a
yeah,
30-year period. It seems just it seemed
yeah,
bizarre to me even at the time. It seems really bizarre that was
yeah.
the rate. But when that happens, tip prices just tip prices went up, but the yields they paid went down. Terrible deal. But we're not in
Yeah.
that position now. This is,
No.
to summarize a bit of a ramble that I've had. This is over the last few months we've had the best deal in 15 years on tips,
Yeah.
and so yes, I think they're a good place to be. A
Yeah.
final note to mention on tips,
Hmm.
because but it related to your question, because I think you asked also how you would use them.
Yeah.
I tend to think of these as something that retirees would want to have, and they're nice because a retiree is going to get inflation protection in Social Security, so that's good. But
Hmm.
outside of Social Security, not so much. Nominal bonds don't give you inflation protection,
That's right.
right? You're getting the same amount each year, and so that erodes the purchasing power. Uh, and if people buy annuities, purchase an annuity, annuities also pay nominal amounts. So
Fixed
annuities,
annuity, sure.
fixed
Yeah.
annuity will protect you the, against its so-called longevity risk.
Right.
So if you live to be 107, you're going to still get paid.
Yeah.
That's good.
Yeah.
Uh, but the amount of the payment shrinking every year if
Yeah.
inflation is positive.
Hmm.
Um, so fixed annuity is great against longevity risk, but doesn't protect against inflation risk. A nominal bond provides good income, but doesn't protect against inflation risk.
Yeah.
TIPS protect against inflation risk. Now they don't
Yeah.
protect against longevity risk, so they're nice if you kind of mix them up with, and that's
Right.
why I advise people to diversify these income sources.
Yeah.
And then the last thing I left out is equities, and I think you've often historically been a fan of dividend paying equities in
Yeah.
particular, right? And
Hmm.
um, but equities also are something in the mix as well
Sure.
for growing increasing capital. So each of those aspects of a portfolio do a different thing. So I'm
Yeah.
not telling anybody put everything in tips or even a majority or anything like that, but
Right.
consider it as part of the solution
Yeah. Yeah. I agree at their current prices, certainly.
at their current prices. Not always, right?
Yeah. Not
Not
always.
always,
Yeah.
right?
Yeah.
In 2020 you didn't want to own anything long. You didn't want to own tips.
No,
You didn't want to own nominal bonds.
that's right.
If people needed, frankly, there wasn't a place to get income because
Yeah.
there just wasn't a place to get income. You just had to realize that and hunker down, hold some cash, spend your cash. Maybe you're going to spend down your principal a little, but it's better than being locked into a bad rate where you're stuck into that for a long period of time.
That's right. And this is also hard to believe, but over various points over the last decade or decade and a half, sovereign bonds of European countries, Japanese bonds were nominal bonds were offering negative
I remember
yields.
that. Yeah. It's not just that you're getting less than the rate of inflation. It feels like protection money. It was
Yeah,
that way,
that's
protection
right.
money.
It
Right?
was, yeah.
Here,
Yeah.
you give me your $1,000 and I'll give you $990 back, but now you're safe.
Right. Now you're right.
They should have
So,
renamed them the
yeah,
protection
yeah.
fund.
That's right. So we've lived through some strange times.
Yes.
So I wanted to move on quickly in the time we've got left. You're not to make you feel old in any way, but you are a veteran, as we've established, of the mutual fund industry, and you have long knowledge of all kinds of interesting things. Talk about how the industry has changed over your career. Certainly, fees have gone down, but what other things, and what maybe one or two crazy things you've seen as well?
Yeah. How the industry's changed. Well, when I started at Morningstar in 1988,
Yeah,
I knew the name of every equity mutual fund in existence, and that counts the fund that had $5 million in it.
yeah, yeah,
And where if you call the portfolio manager, which I did, his wife answered the phone because he worked out of home,
yeah.
and she said, "Bill, there's a call for you." And she said, "Bill's out mowing the lawn right now," but so Bill came in from mowing the lawn to
Yeah.
answer my call,
Sure.
which gives you a flavor of how the industry has changed because it was a cottage industry when I joined, much
Yeah.
much smaller than it is today. Boutique firms,
Mm-hmm.
um, a land grab, an
Yeah.
era of opportunity. There were
Yeah.
new entrants coming in all the time because it was just starting to. From 1984 was the date when the modern fund industry really began.
Mm-hmm.
The stock and bond market rally started in 1982. That's when
Yeah.
stocks and bonds both rallied. It took a couple of years for people to realize maybe there's something going on here.
Yeah.
And starting in 84, it really started to take off. And now we're on the other end. It's a fully mature industry.
Sure.
It's consolidated. Vanguard, as the industry leader, has a higher percentage of the assets than
Mm-hmm.
any industry leader has ever had before.
Yeah.
BlackRock is second, has more than the number two player ever had before. And these are commodity providers. They're doing similar things at a very, very cheap price, rather than being a boutique and trying to differentiate product from each other at a high price.
Yeah.
So we've gone from differentiation and high price to low price commodity products. And it's made the industry, as I mentioned at the start, quite a bit duller to cover. Uh, Much bigger and more powerful, but not as exciting to cover outside of those fringe ETFs.
Right.
But it's been a better place for investors. Costs have come much down. I
Yeah.
actually had this discussion a couple of times with, it's one of the very few times I ever disagreed with Jack Bogle. Because
Uh-huh.
Jack was on the right track of everything, but he was perpetually a skeptic, I guess you could say.
Yeah. Yeah.
And he would tell him, and he would look and say how bad things were in 2015 because he saw some of these gimmicky ETFs, or
Hmm.
he would get worked up over, justifiably, over excesses and abuses in the industry. But of course, those were always there. And I'd say,
Yeah.
Jack, compared to where we were, this
Yeah.
feels a lot better.
Yeah.
And so we agreed to disagree on that. But I do
Yeah.
think it's the industry, although less colorful, treats investors better. And that's
Yeah.
not just true in funds, right? It's true. Like, look at stock trading costs.
Sure.
Look at the opportunity for investors. When I joined, so much, the wirehouses, Merrill Lynch, Prudential Beach, Payne Weber, Shearson,
Hmm.
they controlled the distribution. They controlled not just stock trading, but they controlled distribution of funds. They were
Yeah.
selling high, expensive load funds. They were selling their own product too. So
That's
you
right.
would go to a place and you would be kind of locked into their system.
Yeah.
Those are not consumer friendly things.
Right.
So there's no question at all that from a consumer basis, uh, the industry has greatly improved.
Yeah. And of course, fees have, Morningstar has studied this, fees have come down quite a bit over the decades.
Yes, yes, dramatically.
Yeah.
Um, and I should say, it's not just, this has been a partnership among, or group effort. Morningstar's been hammering on the effective fees for a long time now.
Yeah.
Uh, but investors also came to realize over time the importance of fees, and they started to push fund companies to lower their costs.
Yeah.
And the financial advisors, they're probably the biggest reason why fees have come down, because still most money that comes into funds comes through financial advisors. I
Sure.
don't think people necessarily realize that, because the 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 popular discussions of investments are aimed at people who make their own choices. But
Yeah.
those are a minority. Something
Hmm.
like 70-80% of the money that flows into funds, retail money, outside of 401k plans, comes through financial advisors. And
Yeah.
I saw a survey of financial advisors in the year 2000. They said costs were the seventh most important thing when buying a fund.
Yeah.
Now they would absolutely say it's number one.
It's
They
number
say
one.
cost
Yeah.
number one, track record number two, or tied with that,
Yeah.
and everything else would fall from there. But it was
Yeah.
number seven at the time.
Yeah.
So whereas in my early days, most stock funds would have expenses north of 1%, where the
Sure.
money was going to most stock funds. Now, almost none goes into uh, stock funds that have expenses over 0.50 or 50 basis points, half a
That's
percent.
that's
And the
right.
vast majority goes into less than, say, 20 basis points, because it's
Yeah.
in the very cheapest index funds.
Sure. The
So that's
Vanguard.
the Vanguard, BlackRock, right?
Yeah. Yeah. Three
And it's
basis points for an S&P 5.
same things happening on the bond funds too. The
That's
bond
right.
funds are not yet. I think there is still more money in the active bond funds
Yeah.
than the index, but that's going to change.
Yeah.
The
It
net
is.
flows are into the index bond funds too.
Yeah, yeah. Some managers are still clinging to the thought that, well, the bond market is less efficient. Bonds trade by appointment, some bonds, corporate bonds, and so there's still a business here for us. But I wonder if that's wishful thinking on their
I
part.
think that's somewhat wishful thinking. I'll also say that bond managers have been helped because of the way the benchmarking process works. Like
Yeah,
the Wilshire 5000 or Morningstar's Total Stock Market Index, or there's the major stock market indexes pretty much capture all the stocks in the U.S. stock market,
yeah,
and it's very easy. Those are very accurate benchmarks to compare an equity manager to.
hmm,
The there's bond market has so many more issues, and there becomes a question of what do we let into our index. There's no index that, even the aggregate index
yeah,
that Bloomberg historically did.
yeah,
It's still, it picks and chooses and makes choices, And if you're competing against it as a bond fund, you might well own quite a few lower credit quality issues that
Sure.
that and almost no bond fund managers own as much treasuries, by the way,
Yeah.
as the aggregate
As
index.
the aggregate.
So
Yeah.
so it's a mismatch between the indexes and the funds, and it so happens if the things that the funds are doing in aggregate, I use that word aggregate, as a whole, uh, as has been the case often recently, where corporate bonds have outperformed treasuries,
Hmm.
then it looks like all these active managers are smart, but really they're not being benchmarked appropriately.
Yeah.
So it's a something of a benchmark illusion, I would say. When you
Okay.
look more closely, it gets increasingly hard to make the claim that there are so many opportunities that these active managers take advantage of. And the marketplace is, even if I'm wrong, the marketplace doesn't think I'm wrong because they're buying.
Hmm.
It's going to index fixed income
It's going
funds.
to.
Yeah.
Yeah, that's right. Two more quick ones, if I can. Well, one maybe a little bit longer before we let you go. As we're talking about the growth of the industry and the maturation of the asset management business, talk about the 401k, the rise of the 401k. You've written a lot about
I
401ks.
have.
Yeah, in relation to the growth of the asset management business. How do you assess the 401k? Is it a policy success?
I think it's policy success. I have had a lot of smart people disagree with me,
Yeah,
um, but I think it's a policy success. I think when you look at the criticisms of 401ks, my question's always been, okay, where were we before?
yeah,
Okay, compared to what? And then they'll talk about some golden age of defined benefit pensions that never existed. Because when you
yeah,
go back and you look at the coverage, yes, if you worked for General Motors or Ford or a major manufacturing company or
yeah,
some of the other major IBM
yeah,
in the 1970s, and you stayed there. So that's an important caveat.
yeah,
Uh, you got an excellent benefit, and it was a lot easier than running your own 401k.
yeah,
And hey, welcome to it.
yeah,
But people who worked in all sorts of industries and smaller companies didn't have access to these. My family, almost nobody in my family, except for those who worked in government, ever got one of those sweet
yeah,
pensions.
yeah,
When they retired, and they didn't save really because people investing was for rich people. You might have a little
mm-hmm,
cash in the bank. There was no nudge or push through
yeah,
the employer sponsored system. I'm absolutely convinced that most of the people in my family who were not very well prepared for retirement would be better prepared in today's environment.
yeah,
And as a final note on 401ks, they've also improved over time as well with
yeah.
the default programs where people are defaulted
That's
into
right.
target date funds and the automatic escalation programs where they're automatically enrolled, and that's increased participation and have more people in the game.
Yeah,
So I think overall they've been good. We could talk a long, long time about ways they could be improved, and I have thoughts, but that's for a different time.
sure, sure. And I've talked to Ted Benna
Hmm.
a couple of months ago, and he's corroborated. He agrees with you. He's counted as the founder of the
Yes, he
401k in
is.
some ways. He started it, or he exploited. He was the first one to exploit the
The tax
part of
loophole,
the
right?
tax code. Yeah,
Yeah, I think
that
it's important for everybody to understand when about 401ks is they weren't designed. They were created by accident.
yeah,
They weren't. It's not like Congress or anybody said, "Hey, this is the system for U.S. People, the third leg, the
yeah,
supplement for the bulk of American retirement savings."
right.
It's a was created by clever people from a
That's
tax
right.
code, and
That's right.
it spread because it was better than what else seemed to be out there.
It was better than what we had, yeah.
Yeah,
So
exactly.
that's Ted's argument basically. So, last thing, if we can, I think you are working on a book. Tell
Just
us about
started
that.
it. Yeah, it's called.
Okay.
Well, it doesn't have any. I mean, it just started it. So
Okay.
my tentative name is The Power of Stocks,
Yeah.
and I I'm telling you, there have been books there are a lot of books about stock investing, obviously.
Sure.
Most of them are trading strategies. This is not
Mm-hmm.
trading strategies. Here and there, like Jeremy Siegel has a book, a well-known book, the Stocks for the Long Run.
Sure.
There are books that are more fundamentals of what equity investing is about, why it makes sense. Mine is going to fit in that category. It's just going to come at it from a different angle. I've got
Okay.
some arguments as to, and we've touched on them a little bit, where I do think that um, that capital has had an advantage over labor. That's why investing has done so. Stock
Sure.
investors have done so well. Why that will continue. Behavioral arguments for the so I'm going to make a case as to why, although I'm very cognizant of the extraordinarily high level of returns we've had in equities over the last 40 years, and I don't
Yes.
believe they're going to be quite as high going forward. I'm
Mm-hmm.
also not in the camp that says this has been a fluke or
Mm-hmm.
lucky or magic period and you need to change your strategy. So
Mm-hmm.
I'm going to explain why that is in
Okay.
some great detail because it's a whole book.
Yeah, that'll be interesting because there are people who
There are.
I wonder sometimes if it was if the last 40 years have been a
Oh,
bit of a fluke and if capital has just gotten too big a piece of the
John,
pie.
I'll give you a chance to go attack the draft. I've got some other good, very knowledgeable, well-versed friends and professors too,
Yeah.
on my circle who are much more skeptical of equities than I am. So trust me, as we go
Yeah.
through this process, I'm going to have people, getting a chance to poke holes at this. So
Yeah.
when this goes out, at least I'll know where the potential trouble spots are,
Where
and
the trouble spots could be. Yeah.
with luck, I've anticipated them. I won't go in and just find out. Oh my goodness, I never thought about that.
Yeah, not that I'm convinced, mind you, that labor is all of a sudden going to gain ascendancy or an ascendancy that it hasn't had for a long time. But I
I would
wonder
like to see that,
sometimes.
to tell you the truth. Not so
Yeah,
much as an
yeah,
investor, but in other ways, I think that would be fine. But
yeah,
I'm having a hard trouble envisioning it. But again, a
yeah.
topic for another
Another
discussion.
podcast, right? Well, John Rekenthaler, this has been a great treat. Thank you so much for joining Capital Considered. We appreciate it. This is John Kamarianos signing off for Capital Considered. Thank you for watching.